Good afternoon, everyone. Please excuse me, just we are looking into some technical issues. Please excuse us, just we are setting up technical things. Okay. Good afternoon, everyone. Thanks for joining. Today, we would be talking about few tax planning tips as the tax season has started and the new year has come up. It's a time for everyone to do the start doing tax planning. So every dollar you save is equal to every dollar you earn. In every dollar you earn, you on average, every individual, most of the individuals pay on average 35 cents to 45 cents towards the taxes. There may be some possibilities to save taxes to reduce this how many cents you are paying as a taxes in a legal way. So now this in this webinar series, we are going to discuss about what strategies we can use, and if you have any questions, I'm happy to answer. And this webinar takes place every alternative Wednesday. We are also doing PPP loan and stimulus package webinar series. So every Wednesday, 12 p.m. PST, 2 p.m. CST, and 3 p.m. EST, you can come on to come on to the live channel, either Facebook or YouTube, and you can attend one week. If it is a stimulus payments, the next week is tax planning. So you can at any day, any Wednesday, you can just jump in and you will learn something new from these webinars. And we are also talking. I will also happy to answer any of your questions, if any. We are just having some technical difficulties. Please excuse us. So here in these webinars, whatever I'm sharing with my knowledge, experience, and after my lot of research. Please don't consider it as a legal or a tax advice. It's just a disclaimer. Please work with our tax attorney or a tax advisor or an accountant or a CPA before you implement any of the recommended strategies. So today we will start with some basics. What is the tax return filing due date? So it's April 15th is the tax return filing due date for this year, if you are an individual or C corporation. If you are a partnership or a S corporation, the tax due date is March 15th of 2021 for the last year. So don't wait till last minute. I strongly recommend everyone to please start working with your accountant and start getting the documentation and start filing tax returns as soon as possible. For the individual tax returns, IRS is going to accept application tax returns from February 12th onwards. So, what are the advantages if I file the taxes now? Because you have time till April 15th. The most important advice what I can say is the tax accountants or CPAs have relatively more free time now, so they can talk in detail, or they can spend more quality time to file your tax returns with more to help you more. If you go in the last minute rush, there may be a possibility that they may be doing it in a bit rush. So, and then coming into the tax basics, for this year 2020 tax return filing, the tax rate starts from 10% to the 37%. If you are filing jointly, from $19,700 up to $19,750 of income, adjusted gross income, your tax rate is 10%. And if you exceed $622,051 income together joint filing, then you will be under 37% tax bracket. You need to know that there is always a standard deduction and itemized deduction. For the standard deduction, if you're filing a standard tax return, standard deduction, if you will get $24,800 as if you're filing married filing jointly, and if you are filing individual single, then you can get up to $12,400 as a standard deduction. Someone messaged me, they are not able to see my screen. I'm just trying to see if I can do anything. I'm just trying to fix my technical issues. Excuse me. Okay. Somewhat I'm not able to share my screen, so I will just talk only in this webinar. Okay. So then coming to the next one, tax rates. Then you are eligible every joint filing tax return. If you are an US resident, you can claim up to $24,800 as a standard deduction. And if you have kids and if they have an SSN, you can claim $2,000 as child tax credit. And for every kid or dependent with an ITIN, you can claim $500 as a credit, tax credit. And individual, and when you go for itemized tax return, there are 5 categories which you can consider. All five categories of expenses together exceeds $24,800. If you are married filing jointly, then you can go for itemized tax return. If you are an individual tax return filer, then all five categories together, it should exceed $12,400, all these expenses together. The first one is state and local tax deductions, which we call it as SALT. So the total itemized deduction for all state and local taxes combined should be $10,000. The maximum is $10,000. And if you have any medical expenses, medical dental expenses, and if it's more than 7.5 times, 7.5 percentage of your adjusted gross income, then you can claim medical expenses also in this category. And you can do the charitable donations. Charitable donations you can give, you can give, and up to $250. No supporting documentations are required. And for mortgage, if you have a own home mortgage loan, you can pay the interest and you can claim the interest under itemized tax return. The maximum mortgage loan in this case scenario is $750,000 if you got the home after December 15, 2017. If you bought the house, if you got the mortgage loan and house before December 15th, 2017, the maximum mortgage loan to be considered is $1 million for this calculation. And on top of this, if there are any natural disaster declarations by the president, and if you incur any expenses towards natural disaster, theft, personal casualty and theft loss deductions, those things also can be claimed under itemized tax return. Okay, so now we are getting into a bit more detailed. I will talk about more tax planning now. In this world, nothing is certain but death and taxes. It was told by Benjamin Franklin, but we disagree with the statement. There are a lot of possibilities how you can save taxes in a legal way. So first I want to start this explanation by giving a small variation between what is the difference between tax preparation and tax planning. Tax preparation is the process when you file your tax returns at the end of the year. So you think about the taxes only at the end of the year. But tax planning, it's a process where you need to start thinking about the process even beginning of the year or even before filing a taxes, before end of the year. I mean, before filing tax return, you will start thinking about tax planning, like 1 year in advance. So tax planning is the process of looking at a person's life, business, and regulatory requirements to legally reduce the taxes. So then now I will start slowly getting into tax planning individuals. First, I want to start with the topic, which is one of my favorite topic, which is health savings account. You can you can contribute to the HSA account up to $7,100 for your family, and you can get it as a tax deduction. And this is a triple advantage tax advantage. This health savings account has triple tax advantages. Number one, when you contribute, it is completely tax deductible. And it grows tax free. This money can be invested in the stock market or any liquid funds. That's why it grows tax free. So you don't need to grow. It grows tax deferred. So you don't need to pay any taxes when your money is growing. Then when you take the money out for your medical expenses, it's completely tax free. And you can use it in the lifetime. And at the end of the year, if you don't use these funds, nothing to worry. It will be carry over to the year on year, every year. But the most important point to note here is HSA, health savings account, you can contribute to the HSA account only when you have high deductible plans. So then we will get into the retirement contributions. The early you start, the way you can save more taxes. So you can build your net worth, you can build the wealth in the long run in much higher with higher numbers. So the key here is how fast you start saving the money. Many people think I will start saving money after I bought a house, after my kids got married, after I do this. No, please start doing savings as soon as possible, even it's $100 per month. So there is a compounding power of money. So that the fast you save, the more you can earn over the time. I mean, you can build the net worth over the time. So there are different retirement options we have: 401k, IRA, solo 401k, SEP IRA, simple IRA. So now I would like to focus in this live show, only on the 401k and IRA account. Other topics we will talk in the next series of webinars. 401k has to be sponsored by your employer, and if you are self-employed, you can open on your own. And the maximum you can contribute is $19,500 if your age is under 50 years. If you're more than 50 years or old, you can contribute up to $26,000. IRA account, you can contribute up to $6,000 if you're under 50 years. More than 50 years, you can contribute up to $7,000. You do also have traditional and Roth. So now first we will talk about the traditional. Whatever money you contribute to the traditional 401k or an IRA account, the money whatever you contribute, you get a tax deduction in the same year. But at the time of retirement, when you want to take the money out, you need to pay the taxes. If it's a Roth, it goes in a different direction. When you contribute, you don't get any tax deduction. But when you withdraw money at the time of retirement, you don't need to pay any taxes, even on the growth. So that is the beauty. And there is also one more option. Traditional, you can also do the 50%. If you are having a 401k account, you can do 50% traditional, 50% Roth. You can also opt like that. 50% or any percentage you can opt in. Then the next one I want to talk about is home mortgage interest, which is a very common for most of the individuals. If you are claiming home mortgage interest under itemized tax return, on top of the mortgage interest, you do also have an option to claim mortgage points, late payment charges and mortgage payment, prepayment penalties, and you can claim 2 homes as under primary home mortgage interest. I mean, that second home is not supposed to give it for rent. And like example, if you have a home in India or any other countries or or in any other places, or you have a vacation home, all those interest expenses also can be claimed under itemized tax reduction. So we do under itemized tax reduction, you do also have an option to do charitable donations. So I strongly recommend to do the charitable donations if possible in the stocks or assets, so that when you do the charitable donation in the stocks or other assets, you don't have to pay capital gains on the appreciation what you have on your assets. Of course, you can give it in the cash also, but if there is an option to give it in the assets, in the stock or some other thing, because if there is some capital gain, you don't need to pay those capital gain taxes. Just you can transfer the assets to charitable organization and you can get it. You can get a charitable and you can get a deduction. And you can also even give donations from your home, from the used items, maybe old computer, desktop, old clothes, shoes, anything, any furniture. You can go to the nearby Goodwill and you can do the donation. Whenever you do the donation with the Goodwill, you get a deduction slip. Please collect the deduction slip, the confirmation that you have given. And for everything, there is a rate given in the Goodwill website, tax deduction rate, what the valuation, fair market value of for every product what you are giving. Those amounts can be deducted as under itemized tax reduction. Small business owners. So if you are running a business, you do also have a lot more options to claim expenses, like home office, travel expenses, any meals expenses. If you're going to the restaurant for this year and next year, 2021 and 22, you can claim 100% meals expenses under business, provided if you use it for the business purpose. If you are meeting with your vendor, customers, suppliers, potential customers or clients, those expenses can be deducted. And hiring children, you can hire kids also, and you can pay up to $12,000. But there are different steps you need to follow. I will be covering on these topics exclusively in the upcoming webinars. And you can also claim home office expenses. And when you claim home office expenses, you can claim utilities, insurance, HOA, securities, mortgage interest, and property taxes also. Okay, so then I'm getting into the next topic, Coronabus. The money whatever you got under PPP1 or PPP2 or EADL advance, all those expenses, all those grants or loans are not taxable once they are forgiven. Like PPP1, you might have already applied for the forgiveness, or otherwise once the loan is forgiven, it is no more taxable for you. PPP1 and also for the PPP2. And for the EADL grant, for the EADL advance, if you received an advance up to $10,000, even that is also not taxable for this year. Then I want to talk about FBAR and FATCA reporting. If you are having more than $10,000 aggregate balance in any foreign financial accounts, you are supposed to file for FBAR, which is a foreign bank account reporting. You do this filing with the Department of Treasury. And what does this financial account definition includes? You can include bank account, savings account, checking account, securities account, insurance policies, mutual funds, commodity futures, options, or any other foreign shareholding. And the due date to file this FBAR is April 15th. And if you fail to file this FBAR, the penalties are very high. Non-willful violation is up to $12,000, and it can even lead to the criminal penalties. So it is not worth of skipping filing FBAR. I strongly recommend to file FBAR as soon by April 15th. and there is an automatic extension by 6 months. So if you have not filed FBAR by April 15th, don't worry, you have time till October 15th. And other FATCA reporting, you also need to file form 8938 to IRS if you have more than $100,000 on the last day of the tax year in foreign financial accounts. If you're an individual, then it is only $50,000. Then I want to talk very high level at proposed Biden tax policy. So Biden currently, Biden has during the elections time, Biden has given a proposed tax policy which we are expecting to be passed at any time this year, maybe effective from January 1st, 2021, or maybe from the January 1st, 2022. So we don't have any clue on that as of now. So the corporate tax rate, as per the, I want to just give a very high level difference between our current tax laws and Biden proposed law. In summary, I will be talking exclusively on this topic in one of my upcoming webinars. But here now I want to give it very high level. Our current corporate tax rate is 21%, but it is maybe going up to 28%. Capital gains top rate, currently the capital gain tax rate is 20%, but it is going to become 39.6% if you are at high. There are some conditions which I'm not going to cover now, but there is a possibility of, if you're a high net worth individual, then it can go up to 39.6%. And individual income tax rate is 37%, and it can go up to 39.6%. And FICA taxes, as of for the last year, it is $137,700. Up to $137,700 only FICA taxes to be paid. But now, as per the new Biden rules, you need to pay FICA taxes if your income is more than $400,000 again. This is called donut law. It's like you don't have to pay FICA taxes if your income is between $137,700 and $400,000. If your income exceeds again you need to start paying FICA taxes. And that's it from my side about my presentation. But I am happy to take any questions, if any. Hi, Jeevan. I'm happy to take up any calls and any questions, if any, both on the Facebook and YouTube channels. Hi, Jeevan. Yes, you have an LLC with S Corporation. Okay. Very good question, Jeevan. If you have an S corporation, you cannot claim, you cannot hide your kids without paying social security taxes. So you need to go through you need to go through sole proprietor setup, and there is a separate process is designed. We need to design a process for that. If you are paying your kids from your S corp, it is you need to pay social security taxes. But if you pay your kids through sole proprietorship, then you don't need to pay social security taxes, and you don't need to pay social security taxes, and you can have a family management agreement. You can have an agreement between you can have an agreement between S corporation and sole proprietor for these services, and S corporation can pay money to sole proprietor, and sole proprietor can pay to their kids. So there is a separate webinar. I have given a TV live show and exclusively on hiring kits. You can go through that, or I will be covering this topic again in my upcoming webinars. I'm happy to help you. I'm happy to guide you if required, or you can even mail me. I'm happy to guide you. You can even mail me at anil@agfintax.com. I'm happy to explain in steps in detail. Thank you. Okay. It seems no one has any more questions. So I will ending up this webinar for now. Thank you very much. I will connect you again next week at the same time, 12 p.m. PST, 2 p.m. CST, and 3 p.m. EST. And next week we are going to talk about new stimulus package payments like PPP. What are the upcoming things are coming up? I'm happy to share all the updates, what's happening now in the market. Thank you very much. Thanks for your time. Bye bye.